You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Thank you for joining Minds of Commercial Real Estate. Today we have Tony Volte and Jerome Stone again. Thank you guys for joining us on the show again.
Hey, great to see you, Kamyar.
Thank you.
All right. So today we were going to speak about the big, beautiful bill that was recently passed for the new tax laws. And we would like to get your input, both of your inputs, and how it's going to affect our, the borrowers nationwide. What are the benefits, and if any are there disadvantages to it? So I will let Jerome start, and we'll take it from here.
Yeah, fantastic. Appreciate that. And thanks for the opportunity to share. You know, Tony and I have been waiting on this for seems like months on end. And Trump finally passed what was dubbed the One Big Beautiful Bill, which has many components to it. But one in particular that we've been waiting on for quite a while now is the impact it would have on the bonus depreciation, Section 168K. And Kamyar, last time you had us on, appreciate that. We actually referred to it that, if you watch our previous video, it really talks about a 5-year ROI on some of the tax strategies that we offer at Wilson Hand. But we were waiting for this bill to pass. Now that it has passed, the bonus depreciation aspect of that bill allows one of our tax strategies that utilizes bonus depreciation, that Section 168K. It allows people to take 100% depreciation of a newly acquired asset that's placed into service into 2025, which gives them essentially, a full ROI on their tax mitigation in 2025.
And this is only for, not to cut you off, this is only for 2025 purchases.
Yeah, especially in 2025. So last year, if somebody purchased an asset through us, they're still stuck with their 5-year ROI track and 5-year depreciation schedule. But new customers or repeat customers buying an asset in 2025 will benefit from the 100% bonus depreciation.
Now, is that for investment properties and any commercial property?
So it's applies to specific types of assets. The assets that we work with at Wilson Hand, they're classified as 1245 assets. And that classification is different than real estate. Real estate is a 1250 asset. But a 1245 asset is the type of asset that can harness the 168K bonus depreciation. And we have a few of those assets that we work with. One of them is an RV, a recreational vehicle. I think those campers that can be rented, and take them camping and drive them across the country. The second one is heavy equipment utilized at construction sites. And then the third one we talked about in our last video is a tiny home or an ADU, which even though it sounds like real estate, the way that it is installed keeps it from actually being considered real estate, and it's still a Class 1245 asset. So these types of assets, in particular, the heavy equipment asset, is gaining a lot of popularity with our firm now, because an investor is able to buy into one of these assets and harness the power of that bonus depreciation.
Is there a maximum amount?
That's the beautiful thing about bonus depreciation, is there's no limitation. There's other tax codes and code sections. One we talked about in our last video is Section 179. And that one does have a limitation. It's a pretty typical business write-off, Section 179, but it's limited to what is it, Tony? 1.25 million in 2025?
1,250,000.
So that one has a limitation. Business owners are limited to how much Section 179 they can use in 2025. But 168K, the sky is the limit. You know, they can use 2 million, 4 million, $5 million and take 100% write-off. Now, obviously, there's a cost to buy into some of these assets. There's a math and a little bit of a formula we work with to determine, well, how much or how many assets would a client need to acquire in order to have the optimal tax mitigation in their scenario. Let's use an example. Our average client makes $1 million a year. That client could be a highly compensated executive, professional athlete, or a business owner. And those types of income come from different avenues. The highly compensated executives and professional athletes are paid W-2 income. Business owners, majority of their income comes in a 1099 or a K-1. This bonus depreciation can offset all those sources of ordinary income. So for example, we've got a client, they make $1 million, and let's not say they're in California, because California, they're going to be taxed like crazy. That's a great case study, right? But let's just say they make $1 million, and based on the state they're in, their federal and state rate is 40% tax. So people always think, hey, you made $1 million. Congratulations. That's a fantastic amount of income. But as Tony likes to say, it's not how much you make, it's how much you keep. And if you're paying 40% in tax, you're keeping $600,000 at the end of the day. Well, with our bonus depreciation strategy, that same business owner might be able to invest into a few pieces of this heavy equipment, and they invest $200,000. That amount of investment's going to generate $1 million worth of bonus depreciation. So they have $1 million of bonus depreciation, which is a loss essentially. That depreciation, we're writing off the value of the asset. So they have $1 million write-off against their $1 million of income, which leaves them technically at a zero tax exposure. But it cost them $200,000 to buy into the equipment. So at the end of the day, they have $800,000 of their money left after tax, after acquiring the asset. So it's a pretty big impact in terms of tax savings.
So that's a huge one for obviously a lot of, the borrowers and maybe the real estate aspect, or actually any other aspect, which they can utilize this in 2025. It only kind of gives them about 6 months to utilize it.
Yeah. And Tony can speak to, whether this 100% is going to carry forward into future years, but it is for certain in 2025, we can offset taxable income in a big way in 2025.
Well, especially now too, I see it staying at 100 at least, and until we see, if the current administration, the policies are the same going into a new administration, or if administration changes, you never know what can happen in terms of unraveling. But the good thing is, at this current moment, at least in the foreseeable future, it's 100%. So take advantage, of the time frame while our government throws us a bone, giving us some, not for the taxpayers. So anytime you have advantages like this, you definitely gotta take advantage of it and get it done. And that's where we come in. That's for sure.
What are the carryovers? So if they buy in 2025 and they don't utilize all of it in the tax return for 2025, are there a number of years for carryovers for it?
Not at all. Obviously, you just take it to the next year or whatever.
Is there a limitation, like a 5-year limitation or anything?
No, not at all. You're just carrying it. You're carrying it forward to the next year. Obviously can't bring it back, turn back the hands of time into the previous years, but whatever you don't use, right now, you can use it in 26 and, if not 27, 28. Right now we'll see in terms of the bill was just signed, and obviously there's the laws that are already in place, but there can always be some amendments or changes that we may not see, on the news or anything like that, that Congress and the Senate and everyone's doing in the background. But at least fortunately, the biggest win was this 100%. Put it in perspective, just about a month and a half ago, it was 40%.
Huge difference.
Oh, it's massive, massive win for the taxpayers, regardless of your political, affiliations. Just with this 100% and a lot of the tax aspects of the bill, it was
Correct.
actually a big win for taxpayers. So,
What would be another one of the big changes you guys, based on the summaries that are out there? Obviously, not everybody knows every single detail. What is that really important for our viewers?
It's funny. We've been hyper focused on bonus depreciation. That involves the type of assets that our firm works with, and we've designed strategies specifically around bonus depreciation. If it's not broke, don't fix it. And it's been working so well. The change in the tax code has just made it an even greater strategy to work with. And the uniqueness of having a law firm that handles it compliantly, understands the tax code, designs the contracts so they can be efficient and compliant, and ensuring that every client that participates in the strategy understands, what are the steps involved in order to take that deduction. In fact, one important aspect of utilizing bonus depreciation with these types of assets is what's referred to as material participation. Kamyar, I think you mentioned, or it's been talked about, passive income. There's a big difference between passive income and active income, which is the same for depreciation. And someone who just invests in something and is not active, that's considered a passive activity. We want to offset the ordinary income and the active income. And so in order to do that, we help our clients materially participate in the strategy and in this. We're essentially creating a micro business for these clients. They've got to participate in that. We have several suggestions of activities that they would participate in. And by so doing, they become an active participant in the business. And then all of that depreciation comes across as an active loss in order to offset their active income. Tony, I don't know if you want to talk maybe just a little bit about the specifics about it, our equipment rental program, the cost per share, the multiple that the clients receive.
Well, especially with the equip lease strategy, Kamyar, we're always working off of 5-to-1 multiple. So for every dollar, viewers out there, for every dollar that you put into any of our asset-based rental strategies, you'll get a $5, a $5 loss, taxable loss to offset your gain. So we're not reducing the tax debt directly. It's not like a tax credit, for example, or anything like that. It's all about reducing gain. So there's a 5-to-1 multiple there. If you back into it, it ends up becoming a 2-to-1 in terms of tax savings, especially in our state, Kamyar, California.
Definitely. We're one of the highest federal and for everybody, statewide, we're one of the highest, I believe.
But now, as opposed to several years back, we were always more focused on, not more focused, but most of the benefits came to non-W-2 earners. But right now, we have a good window, at least for the foreseeable future. If you're a high income W-2 earner, a lot of our Jerem and I are clients, high income W-2 earners like doctors or lawyers that work for hospitals or law firms, high W-2 right now is the perfect window. We have strategies depending on your financial price points. For example, our Equip Lease. It's just a rental equipment strategy. $27,500 gets you a $137,500 deduction. Now, this is really good, in terms of tax planning. Most of your strategies out there, all of you watching, your CPA, as good as they are they use traditional planning. It's going to be contributions to your 401k or health savings, or maybe a dollar for dollar charitable deduction. Obviously, advanced tax planning like we do, it's a more advanced. It's 5-to-1 multiples. We're using leverage, obviously, but at each time where there's risk, we do where there's risk, we do our best to mitigate, those risks. I think I created a new word, mitigated and risk together. I called it
MISC.
For all the viewers out there, I'm creating new words. It might be a new word to use. We're going to miss you right now, but the whole goal obviously is to, a lot of these strategies back in the day were just used for the real wealthy, but now we've brought these type of strategies to your everyday, type of taxpayers, and even more so now, especially with some of the strategies we have. We're able to help more people, especially the W-2 earners, which is a really, really big, because they were the most affected. So, the big, beautiful bill came in and protected now the W-2 earners, obviously, not even just tax stuff, but, that we would work with, but no tax on tips, no tax on this, there's a lot of different things that this bill did just beyond our own tax mitigation strategies. So it's important to, consult with your CPA and then see where you can benefit in addition to tax mitigation benefits, like we do. And we have many different types of rental strategies. Right now, our big ones are the tiny homes and the equipment lease strategies. The only major difference between the two are the price points. We have tiny homes, $375,000 deduction, $75,000 cash outlay, 5-to-1. We have the equipment lease strategies, $137,500 deduction for a $27,500 deduction cash, outlay. So it all depends too on your needs and your wants. You may not need $375,000, maybe just $137,500. Unfortunately, viewers out there that need less than that, we can't go any less than that. Our minimum right now is the $137,000 $500 deduction for a $27,500 investment. But again, if you foresee yourself having income, as we were just saying, Kamyar, you can always invest $27,500, get that $137,500 deduction, use what you can now, and at least you're having something in the bank for 2026. So it doesn't mean that if you don't need that, you can't use it. It's not use or lose in 2025. So as we were saying, you just can't go back.
Got it. Well,
I wish. That was really good. Now we'd be having a different conversation on
absolutely.
Yeah, for sure.
That would change all of the 2024 taxes that are coming due if that would have happened for retroactive.
And the phone would be off the hook right now.
We wouldn't be having the time for talk right now. Well, thank you, Tony. Thank you, Jerome. Appreciate the, giving the analysis of the big, beautiful bill. Obviously, there's going to be a lot more to talk about as it expands and we learn more about it and which other aspects it's going to, help potential borrowers save tax money. What is the best way borrowers can get in touch with you guys to speak further?
Yeah, appreciate the platform and the opportunity to chat with you, Kamyar. It's always a pleasure. We know your listeners know how to contact you, so that's a great way. Reach out to Kamyar. He can get you in touch with us. Also, our website is wilsonhand.com. And Tony and I, you can reach us by first name, last initial at wilsonhand.com. Love speaking with people. You know, we're not charged by the hour lawyers. I'm not even a lawyer myself. I'm just a tax strategist, if you will.
Really good one.
Tony is an attorney, but we love talking with people, understanding their situation and educating them. Here's your options, and ultimately leave it up to them if they're interested in participating or not. We're just here to educate.
Thank you, gentlemen, both very much for your time, and we'll be in touch.
Likewise. Thanks,
Perfect.
Kamyar.
Take care.
Kamyar, thank you everyone
you.
for watching.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.